election has come and gone, and with it, the knee-jerk reactions in fixed income markets, which included an aggressive sell-off in U.S. Treasuries. As we await December monetary decisions by the Bank of Canada and the Fed, of course, where are the investable opportunities in fixed income markets lying ahead of us here? Joining us now for a multi-sector perspective on today's fixed income markets is Institutional Portfolio Manager Beau Coash, and you're here in the flesh, joining us in the Toronto studio. Nice to see you.
Beautiful day in Toronto.
It's a beautiful day
in Toronto.
Welcome to winter.
Took us 4 hours to get in last night late, but we're here.
No. It's always the first snowfall that gets you.
It really is.
Then you get used to it. Delighted to have you here and to have a chance to go through some of these topics with you at the end of the year, at the beginning of next year, whatever you want to call it. I'm going to ask you to first set us up. We'll invite everyone to send their questions in, by the way. What's your call on inflation here? How do we look at inflation if we back out of everything else from where inflation goes?
So we're pretty close to Fed expectation. I think you all up here have a similar target on inflation, 2%. Ours is 2%, roughly at 2.5%. A lot of things could happen, though, over the next several weeks, months, coming into new regime down in Washington. A lot of promises during the election about taxing a lot of imports, things like that. That is already feeling it could be walked back a bit. A lot of the concepts that were happening during the pre-election feel like they're being walked back a bit, and I think there's a lot more common sense being discussed, and that's all good. And I think we've seen that reflected. We've had a Besant who is nominated for a very big role, who's been a kind of a deficit hawk. That's really helpful because
he's growth out of debt.
We have to grow, because if you think about where we stand on our budget, on any big national budget, there aren't many levers you can pull to save. On the savings side, you have to grow.
So you've got what? You've got the medical side.
You got Social Security.
Social Security.
And Medicare are the two biggies. Then the third and by far smaller bucket is defense. Mm-hmm. So what you're really hoping for is some kind of peace dividend. So what does that mean?
Yeah, what's that mean?
That means, does Russia-Ukraine figure itself out? Does Israel-Hamas figure something out?
Because there's less inflation?
No, because we need those peace dividends and not spend as much in defense.
Got it.
To then be able to not have these big deficits. So we're spending less in defense. We can put that back into other parts of the budget, and therefore we can cut our 6% deficit to GDP back to a normal peacetime deficit to GDP of 3% in the U.S. Long-term averages in peacetime are half of what they are today. You could argue that the U.S. really isn't in any kind of massive crisis today, like we were in COVID when we shut the economy down, or the GFC when we had to save the banking industry. But today we still have 6% deficits. And it's just because we're in a system that, we've got an aging population. These are all very familiar themes. Aging demographics and less productive workers, and that's not a great. So we have to go back to a growth regime. And so if we can grow, then all of a sudden we can get deficit to GDP closer or towards 3%. Versus keeping it the way it is now. And that's I think that's the Hail Mary solution for getting us back in line with our debt issue.
So peace dividend is a piece of that, pardon the pun there. But the inflation piece is also massive there as well. What do we see short term and longer term in your mind?
Well, I think that we're pretty close to target at 2.5. I think you can already seeing some activity in companies bulking up orders in anticipation of maybe a new regime of taxing the rest of world of goods that come into the U.S. So there might be some pre-ordering. There might be a little bit of that kind of FOMO of purchasing managers needing to get goods in before new rules come in, right?
So a little bit of inflation because of demand.
You might have a little bit of spike from a little sugar high from I better beat the new policies, at least to hedge my job as a purchasing manager. So that is a a legit possibility. We saw that in spades during COVID, when if your job was to get product out on the shelves and there was huge demand early in COVID for product, you were buying more than you ever needed because you were kind of hoarding the product cycle or the product chain so you could get enough product on the shelves. Then we had a goods recession a bit, and it went to services when we had the immunization and the vaccines. People said, I don't want to buy stuff anymore, I want to go travel. And so we saw lots of demand for air travel and experiences and things that were taken away during COVID.
And even now, we're seeing, you just had
Airlines
Friday, we've just had
Cyber Monday.
Right.
We're back to being a goods. So because we didn't buy goods for a while, now it's we got to buy goods. And so Black Friday and Cyber Monday were record sellers in terms of consumer.
Consumer consumption looks fine.
Looks fine.
Looks
And
fine.
we have proprietary data. We run about 13% of all companies' 401ks in the US. So we take that data and we look at we have a jobs number twice a month that's from actual data, not survey.
So did you know what's going to happen on Friday?
No, we don't. But we also have, because it doesn't have the government. So that's a big stabilizer. But we also have a wage data piece. And those are doing fine. They haven't dropped off a cliff. They're rolling just a touch. But it feels to us like the economy is fine.
Right.
Both of those sets of data, wages and employment, seem to be fine in the public sector. The only thing's missing from that is the government piece. That should be fine, although we see a lot of roll-up of kind of this new regime taking a lot of jobs out of the government, and that could be interesting. But remember, we've got a new regime coming in who likes to see the stock market go up every day, and that's the way that regime will measure their success.
So why do you need bonds?
Because we haven't had yields like we have now since 2006. This is a constant theme. You and I have talked about this before. We wrote a paper at the beginning of 23. If you don't like bonds now, maybe you just don't like bonds. Mm-hmm. And we've made some progress. We've gotten all the losses we got from 2022 when rates were going up and up and up and up, down 12, 13% in the indices. Now we've gotten that all back and then some. We're up probably 14, 15% since the beginning of 23. So we've gotten a lot of performance back, but we're still hanging out at 5% yields, which is extraordinarily attractive when you compare it to historical yields. And you can also get that in the front end in money markets or short duration treasuries, short duration product, four-handle yields. The only issue with that is you have some reinvestment risk. So if you buy the front end, you may miss out on some of the duration impact in a portfolio. I know that's getting back to bond nerdship.
No, we're going to go right into bond nerdship. I'm excited to.
But you'll be better off if we get a normalized curve, treasury curve, which is from 2-year treasuries to 10-year treasuries, if it's 100 basis points slope going up, so you get paid less for shorter term, you get paid more for longer term, and you typically have about 100 basis points in that curve. If we get back to that from today, we're only like a 10 basis point steep. If we go to another 90 basis points, you can get pretty good returns in fixed income, and you're not taking the risk you are in equities. That's the most important thing about this risk-adjusted return. Fixed income is much higher in terms of volatility than it had been pre-COVID, but because we have the government stepped in, we've got a lot of treasuries, we issued a lot of treasuries, we have a lot of different views on where the direction of inflation and tax regimes and things like that are going. So we're going to have volatility, but you're at 6% vol versus 3 traditionally. That's a 30-year record of being 3 vol. We're at 6 volatility now, so it moves 6% up or down annualized. Compare that to stocks at 15%, so you're still getting 1/3 the volatility of stocks, and you're getting a 5%, close to a 5% yield. Depends, 4.5, 5, 5.5 in that range. If you buy an active manager bond fund, even the ag will work. An index will work. It won't work as well as active in fixed income.
So is right now a better or worse time to say pre-September when the Fed cut to buy dividend stocks versus a bond? You know, they do often get compared, maybe not always fairly, but they do. They compete with each other.
They do. I think it's as good. Things haven't, we're tighter by 20 basis points from the wides from just post-election. So we actually extended our duration a little bit, a half a year. We've tightened 20 basis points on our 10-year. That's not a massive move. I think things are still in place. From the end of September till now, we actually have higher yields. We've given back about half of the gains this year from fixed income. So it's actually more attractive than September, marginally. So you still have a great opportunity. You haven't missed any windows. And it's really hard to time the optimal window to invest in any asset class, much less fixed income.
But regardless, it's still an attractive time because the rates are, even though there's been cuts, are still relatively high to what they were 2-3 years.
Yeah, relatively high,
decade
depending
ago.
on what your needs are. If you can be a lifetime investor and don't need the capital for a very long time, then any one of our audience out there today would say equities. If you've got some short-term demands or you want to balance off your equity portfolio, bonds are a great time. It's a great time to buy bonds because you actually have good returns now where you didn't have that just a few years ago.
There has been issuance on the corporate side. It seems like you just wake up to it every single day. Are we swimming in that? Is there anything to note about that? Is there anything bad about that?
Demand is insatiable.
It is, it seems.
And so the little secret about corporate issuance is you can't bring deals unless the market wants those deals. Like you can't, banks aren't going to take a risk of saying, let's issue this bond into the marketplace and let's see what happens.
Right.
Typically what's going on is there's a bunch of pre-calls made to the biggest buyers. What do you think about this kind of name in this maturity at this price?
I assume that you're on the receiving end
We're
of that
on
call.
one of those calls.
Yeah.
Mm-hmm. And the feedback would be yes, no, maybe so. And then they take that information, they roll it up, and they're like, yeah, we can get this deal done today. And here are the potential buyers, and let's go round up the orders. Now, the market structure's changed dramatically from, say, 10 to 15 years ago. There's a huge passive index market. So there's a lot of index buyers out there. And the way that the indices work, I worked at Lehman Brothers, which is the Lehman Ag, that's where it started. Then it became the Bloomberg Ag, the Barclays Ag, and now it's the Bloomberg Ag. It's the same team that is actually running it there at Bloomberg that was with us.
And you were on that team.
I wasn't on the index team, but I was part of the team that used all this index and analytics with our clients. They all wanted to know what was going in the index next month, and they wanted to track for duration and everything else. But it's a very different index than equity indices. So the fixed income indices are based on how big of an issuer you are, how many bonds you're issuing to the marketplace, how many billions do you have outstanding. Those are the biggest names in the index, and then it goes down to the smallest names. In equities, it's the best companies, the biggest market caps. So if you do really well and the market loves you, you're going to be up on top. If you don't do really well and the market doesn't like you, you might drop out of the Dow, or this is how things drop out of these indices. It's really a popularity contest in equities, where in a momentum, versus in fixed income, it's a negative selection index. You don't necessarily always want to be investing in the biggest issuers of bonds because there's always bonds supply coming at you. So if there's already a lot of big bank bonds in the marketplace, and that big bank comes to the market again, everyone might be full, and the prices may not be that interesting, and so they might have to walk it back a little bit to get it done. That's opposed to maybe an industrial that doesn't issue that often. It's going to be a new name in the index. All the index buyers come storming in to buy that $500 million, $1 billion tranche, and you got oversubscription. They can tighten the price talk of that deal from, let's say they're going to initially offer it 100 basis points, and they can bring it at 85 instead, or 80 off, 80 over treasuries. That's a big savings for these companies. You're saving 20, 30, 40 basis points
Yeah.
just because there's so much demand, and nobody's going to back out of those deals because they want the exposure.
And there's a diversification piece to all of that for themselves. So in this market, take us to the sort of why for the multi-sector approach, because it sounds like you would be spreading across the different bond sectors, obviously, for this approach, but you're actually naming a few different areas that seem like you don't need to go so far. Why do we need to go across?
We've flattened out our risk across the portfolio because
Okay.
we don't think we're not getting paid for taking a lot of risk today. So our investment grade credit, because of the valuations, I was just discussing how tight valuations are. Just put it into context. Today, IG credit is at 80 spread over treasuries. That's, in order for a company to come to the marketplace, you take a 10-year treasury, you add the spread to it, and that's your coupon. So today, on the average, the index is at 80 basis points over the like treasury. But if you adjust that for 2006, when we were last at these kind of levels, the index is a lower quality index. So the index now has got 50% triple Bs. Back then it was 30% triple Bs. The index then was longer, now is longer by a year. Back then it was shorter by a year. So if you make those adjustments, you're really buying credit today at 60 over in terms of a comparable by taking those basis points away from those valuations based on the lower quality of today's investment grade bond market. Does that make sense?
Yeah, and it's fascinating. It makes me want to ask about high yield, but let's.
And high yields is a higher quality market. So you've got a lot of double Bs or triple Bs that have gotten downgraded into high yield.
But are still very good companies.
And now they can make the round trip back up again. And so a lot of double Bs trade a lot like triple Bs because there is that anticipation of kind of the fallen angels into high yield and then the rising stars back out of high yield. So there's a lot of play between that triple B, double B space.
Is there less opportunity in high yield, again, than there was sort of 2, 3, 4 months ago? It was pretty hot
about
2 or
the
3,
same.
4 months ago.
It's about the same, and I would say the same thing. Fundamentally, we're seeing companies having good earnings.
Okay.
Default risk has actually come down, not continuing to rise. It rose a little bit in the early part of the year, and now we're back down to 2% to 3% default rates. Typically, you start getting concerned when you get into the 4+% default rates. We actually went the other way, back down in default rates because there's a lot more liability management exercises by these companies. There's a lot of private equity involved. They can basically renegotiate terms. They don't want to see the high yield market fall apart or the loan market fall apart. So there is a lot of activity to make sure that these companies don't fail because they're wrapped up in limited partnerships and everybody's rooting for those partnerships to work. And so there's
a lot of cushioning and sort of help.
There's a lot of forgiveness. There's a lot of extension. There's some lawyers will tell you there's a lot of extend and pretend. Pretend that things will get better. Now, it can work. So if rates start coming down fast enough to help these companies save money on interest expense, because that's where most of the issues are happening, because rates ballooned up.
Yeah.
So interest rate expenses went much higher for floating rate, which is the loan space for those companies. And if rates come down even moderately over time, that'll help save or help a lot of these companies compete.
Leveraged loans still an area of interest, though, for you?
We still like levered loans because the Fed has brought down interest rates, but not at a massive cut. Typically, you see a sharp drop in interest rates from the Fed when there's a crisis or something like that. There's no crisis. So it's as slow as you go.
Don't say that out loud.
It's 50 bips the first cut, 25 the last cut, probably 25. So you're talking about 100 basis points off of a 5% start.
Okay.
That gets you to 4%, maybe close to 5% yield in some of these strategies. It's fine. It's still pretty attractive.
We're living in a soft landing in your mind?
Or no
at this
landing.
Stage? Or no landing.
Or no landing, because it feels like, if you just scan kind of how companies are doing, it feels like we're back to maybe mid-cycle. We got to the point where we were getting a lot of clients, why do you have so much high yield? Why do you have so much this? Why do you have all this risk? And our explanation was we weren't seeing a reason not to have it. There was no indication that we were seeing any signs of recession. And I think you could say that we're there now. I think if you listen to all the prognosticators on CNBC, nobody's screaming about a credit cycle.
Right.
It's really all about macro, and it's about rates. And that's where the risks are.
There's a question here that ties into that. So the question is, if policy becomes inflationary and Fed rates aren't cut, how might that affect the fixed income market? So if you're living with rates where they are or potentially higher.
Yeah, so if rates stay the way they are, you're going to get a very attractive yield. And I don't think many people will complain about getting carrying a fixed income return of 4.5%, 5.5% for the foreseeable future. And I think that's a decent outcome for a lot of people.
We've spoken to some of the people that you work with on your team, Stacy, Michael Pledge. Just tell us a bit more about the team, how you guys all work together, guys and gals work together.
We have a very collegial team. We have a very collegial environment. We all the portfolio managers sit within about 3 feet of each other. So it's less than 5 steps to get to the furthest one away from you. It's a team-based approach, but in every portfolio there's a fiduciary. So there's a tiebreaker. So we don't want to have no fiduciary in this whole team where no one's accountable. So we absolutely have accountability. We have a debate about a lot of these big topics. Where do we stand on inflation? Where do we stand on, our treasury exposure on versus where we are on credit versus where we are on securitized versus high yield. We talk about these items constantly throughout the day.
Can you fill us in on all those pieces right now? Where are
Sure.
you in terms of treasuries, in terms of high yield?
We have never been more overweight in treasuries. We think that never in our multi-sector strategy.
Yeah.
So we find if you look at the break evens, and this is maybe a little bit bond nerdy, but at 80 OAS, if we just go back to the median of 135 spread over treasuries from 80, so that's what 55 bips wider, you'll have been better off over the next 4 years to have been in treasuries over being in credit. It'll wipe out all that return that you got from owning that credit spread. You'll wipe it all out. So if you got we have 4 years to have an event.
Right.
So we'll be better off being in treasuries versus being in high grade credit. So mortgages were underweight. They don't really yield all that much. It's actually been one of our best relative return underweights or positionings in the portfolio. We have 0% agency mortgages in the portfolio, so that's really worked well. In the last couple of months, they've extended. They're actually wider in spread, so it's worked out nicely that we've been underweight. We were one of the few shops out there with an underweight. Everyone has been loving agency mortgages because the idea was that we would get a normalized curve and that you basically had to get to 2% to have a lot of refinances in mortgages in the US. Different mortgage setup than
we have a different
here.
story here, yeah.
Our story is, you basically had people who took advantage of low rates. They locked in long mortgages. So it didn't really hurt anybody that rates went up in mortgage space because we got rid of all the floating rate structures when everyone got hurt in 07 and 08.
Yeah, you guys deleveraged in a way that we didn't.
Yeah.
And it's a different story there. Carry on with the different areas.
So corporates were way underweight in high grade corporates. We have very little, because of the higher quality, the less quality in terms of the IG credit index that we talked about, longer by a year in duration, and also got more triple Bs. We just don't think they're that attractive. We've taken down our plus sector exposures a little bit. So
interesting. Mm-hmm.
We have shaped those up a little bit, but we still are trading from the long side. So that's how we get the carry in the portfolio. And we would say high yield is a higher quality benchmark now than it was. And then in loans, we're picking companies that typically don't have any, that are basically not only loan in their balance sheet. They've got high yield bonds and loans. So if they default, the high yield bonds take the hit, not the loan piece.
I see.
Because you're higher in the cap structure in loans.
Yeah.
So we only look at companies that pretty much have the seniority in line up in their cap structures.
Just for a moment, within multi-sector bond and the way that you look at this, you're going around the world as a global way to look at the world. Just give us a quick couple of minutes on how you're looking. Is Fortress North America still the best place to be?
Fortress North America still looks really good. You know, you see the anecdotes from France, you see anecdotes around the world. So it's in the headlines. There's no hiding from that.
That's right.
And so we still feel really good. Although global credit, we have a team in London that has had great rebound in their in that how those bonds have performed, and that's all working really well. I think the bank panic or the Credit Suisse UBS situation is now far behind. That's kind of resolved itself. So I think there's been a nice rebound in risk taking in Europe, but again, that team is also dialing down some of that risk. So yeah, we are global. We've got some Pemex bonds. We really like.
That's oil
Pemex, which
Brazil?
It's the Mexican. It's
yeah.
oil in Mexico.
Got it.
And we think it's going to be heavily backed by the government.
Of course.
And so that's the whole. When the regimes support Pemex, verbally, strongly, spreads tighten. When they seem like they step back a little bit, spreads widen. That's how Pemex works.
You're not going to be happy with me ending on crypto, but this is the question.
Whoa!
What are your thoughts on convertible bonds that crypto-related companies are using? You can say no comment.
Well, I mean,
but
no, we have looked at the MicroStrategy's convert. I mean, I'm not going to say whether we bought it or not, but it was an interesting structure.
Yeah, it's interesting.
It's probably one of the few ways you can get exposure in crypto in the fixed income space. So we thought it was a really interesting structure. I'm not going to comment whether we bought it or not.
Okay.
But obviously, almost since that deal, MicroStrategy is down significantly from that level. So I don't really have much else to add. I know that we like Bitcoin as a diversifier for what clients want. We're not pushing crypto on anybody, but we want to make sure we have it available for clients who want to invest in crypto.
So looking ahead to the new year, and it will be a new administration that will actually hit the ground, probably running. What sort of 1, 2, 3 that you'd like investors just to know that you're thinking about?
So we're thinking about being really flat with our risks. Mm-hmm. We think patience is our best idea.
Interesting. Mm-hmm.
We know that in the previous regime that there was a lot of volatility in words, and we want to be prepared to take advantage of those words when it benefits us. We also know the market structure continues to change, where the buy side has a lot more leverage because there's no balance sheets to help clean up messes. The buy side helps clean up the mess. So we benefit from that pricing when we help clean up the mess if we have strong conviction. So that's what we're hoping that we know that the next 4 years is going to be really noisy. Yeah. I think in that regime you don't want to have really strong views because things can change in a tweet. So you just want to be flexible. I think our flexibility, and we're in a great place to be flexible given all the treasuries we have. We're not locked in to a strategy, and that's the other thing. I think we have a nice strategy now because we have good yield. So door number one, we have 5-ish% yields. If nothing happens, we stay higher for longer. We think clients win because 5% yield at a 6% vol is better than a 5% return in equities and a 15% vol.
So you're sitting in a good place
on a vol versus return perspective, if that makes sense.
It does, absolutely. It's a good place to close it out. We thank you for joining us in person, and thank you for sharing all of your very deep and intelligent thoughts. Thank you, Beau Coash, for being here.
Thank you, Pamela.